Hello and Assalamu alaikum. All right. Our lecture for today is on IFRS 16. All right. Now we'll be targeting Section A questions of IFRS 16 today. Probably we'll do Section B questions as well. All right. Now, in Section A, we have the first question that we have on IFRS 16 leases is question number 76. All right. Let's start. It says during the year, ended 30th September 2024, Hyper entered into two lease transactions. All right. On 1st October 2023, Hyper made a payment of 90,000, being the first of 5 equal annual payments under a lease for an item of plant. The lease has an implicit interest rate of 10%, and the present value of the total minimum lease payments on 1st October 2023, that is the date on which the lease was undertaken, was $340,000. All right. On 1st January 2024, Hyper made a payment of 18,000 for 1 year lease of an item of equipment. All right. What amount in total would be charged to Hyper's profit and loss statement for the year ended 30th September 2024 in respect of the above transactions? Number one, when you talk about a lease, you're recognizing a right of use of an asset, right? So first of all, let's say when you talk about the debit side of it, the debit side of the transaction, you have right of use of an asset in the balance sheet, and that right of use of an asset is basically leads to depreciation expense, right? So first of all, you'll recognize depreciation expense. Now, the lease was for 5 years, right? Because you're making 5 equal annual payments. All right. The right of use is 340,000. So you can simply divide by 5 to get your depreciation expense, right? Next up, you have the credit side, which is the lease obligation, right? You have lease obligation on the credit side. Now, when you talk about the lease obligation, obviously that leads to a finance cost. All right, a finance cost on the lease obligation. Now, how do you calculate the finance cost? You simply have 340,000, but out of that 340,000, 90,000 was a down payment. Down payment means that this first 90,000 of let's suppose I'll call it a loan. All right, I'll call it a loan just hypothetically. All right, this 90,000 of the loan of the lease obligation wasn't used at all, right? It wasn't utilized at all. In fact, you took 340,000 and you immediately gave back 90,000, right? So out of 340 minus 90, you get 250. This 250 was used for the entire year. Therefore, the interest that you will charge will be 10%. Let's say that, let's work in thousands because I've already done the above figure in thousands, right? So you have 25,000. All right. What else? Is there anything else? Yeah, on 1st Jan. Oh, all right. There was a 1 year lease on 1st Jan 2024. He made a payment. It's a simple rental expense. 18,000 January, February, March. So 9 months, right? 9 months. Next right now. Yeah. So this is 18,000 into 9 divided by 12. Right. So your answer becomes 106,500. Do we have an answer? Yes, we have option C as the answer. All right. We have option C as the answer. Now, moving on. It says Z entered into a 5-year lease agreement 1st November to 20x2, paying 10,975 per annum, commencing on 31st October 20x3, which is in arrears. Basically, the payment is being made in arrears. All right. The present value of, it's not actually arrears, it's basically by the end of the lease. All right. By the end of the year, sorry. The present value of the lease payments was 45,000, and the interest rate implicit in the lease was 7%. There's one thing that there's a practical debate on it, and there's one thing that students of F7, that is FR and SBR, should know. It's that if you don't have an interest rate implicit in the lease, what do you use? You guys know that? If you don't have interest rate implicit in the lease, you either use the entity specific rate, which is basically risk-free rate. You can call it a LIBOR or a KIBOR, adjusted for entity's own specific risk profile. All right. Now it says, coming back to the question, it says what is the amount to be shown within non-current liabilities. Now this is talking about non-current liabilities. Remember, you need to know exactly what the question is asking. All right. So it started. All right. It's 31st October 20x3 they're talking about, right? The lease was taken in 1st November 20x2, right? So let's make a lease amortization schedule. So you have the balance at start, balance of lease obligation at start of the year. You have your rental payments. What were the rental payments? In fact, the rental payments were paying 10,975 per annum. All right. You have interest and you have balance at end. Right? Now, let's say the first payment was made on 31st October, right? 31st October 20x3. All right. So 20x3 was the 31st of 20. I'll take it as 2003. All right. Balance at start was 45,000. The rentals that you were paying was 10,975. Out of this 10,975, at 7% interest, there was 7% interest applicable to it, right? So 7%, 7%. I'll just put 7% over here, right? So this, oh, sorry. Yep. Now, what balance do you have at the end? How do you calculate the balance at the end? So you have, sorry, sorry, there was a, now we were calculating balance at end. So we have 45,000. All right, balance at end. So this, right? So this is your minus this, minus rentals plus interest. Yeah. So this is your balance at the end, right? Now, balance at the end of the previous year will become the balance at the start. You have 20x4. Remember, for current liability, I've told you guys that you have to work up till the next year in order to get the difference between the current and non-current liability, right? So your rentals remain the same, your interest changes, yeah, and your, so 28802. Do we have an answer? Yes, part B. All right. Oh, sorry, option D. Okay. So this is your answer, right? 28802. Why is it written like this? All right. Next up. Sorry. Question number 78. IFRS 16 leases permits certain assets to be exempt from the recognition treatment for right of use assets. There are two assets, right? Two types of assets, two types of transactions. Which of the following assets leased to an entity would be permitted to be exempt? So it's lease less than 12 months, 12 or less than 12 months, right? And the second one is lease of an immaterial amount, immaterial, insignificant amount, all right? Low value asset, right? A used motor vehicle with an original cost of 15,000 and current fair value of 700 leased for 24 months. Now, what you have to see is that this is, the lease is obviously recognized at cost, right? The cost. A new motor vehicle cost of 15,000 leased at 24 months. Again, just because it's more than 12 months, you cannot recognize it for as operating lease, right? Now, part A also is for 24 months. A new current motor vehicle with a cost of 15,000 leased for 24 months will be rented to customers on a daily rental basis. No, a new motor vehicle with a cost of 15,000 leased for 12 months. Now, even though the cost does not seem to be immaterial or of low value, but it's still of less than 12 months, right? The lease is of less than 12 months. So this can be exempt from the recognition treatment of right of use assets, right? The other three are for greater than 12 months, right? All right. On 1st January 2023, Rabbit acquires a new machine with an estimated useful life of 6 years and the following agreement. An initial payment of 13,760 will be payable immediately. Will be payable immediately means, you know that, right? Now, 5 further annual payments of 20,000 will be due commencing. All right. So the interest rate implicit in the lease is 8%. The present value of the lease payments, excluding the initial payment, is 86,240. All right. What will be recorded in Rabbit's financial statements at 31st December 2024 in respect of the lease liability? I want you all to pause the video, try this, and confirm the answer with my working. All right, entry. All right. So, excluding the initial payment, that means they have excluded the initial payment. That means they have deducted it already. So the ROU turns out to be 86,240 plus 13,760, right? And lease liability, right? Now the initial payment that they made was number one, 13,760, and debit, bank credit 13,760. All right, and then they made another payment of 20,000, which is basically rental expense, right? But obviously it's in advance, so I'll deduct it from the lease liability only. Bank credit, right? Now, the outstanding lease liability is, let's check. So the outstanding lease liability is this minus this, 66,240, right? I'll just do my working over here only because you need current liability in this as well, right? Interest is 8%. Your balance is starting from 66,240, right? And you have some current liability as well, right? I'll update the sheet. 20,000 is your payment, and you need current liability as well, right? This will be this minus this, right? So I haven't updated this, right? This is your non-current liability. 20,000 is your current liability. Oh, I haven't updated dates as well. Sorry, my bad. So that's 31st December 2003. This is 31st December 2004, right? For 31st December 2004, you have interest payment as 4123. So the only option that you have in 4123 is A. All right. The current liability that is to be paid in the next year, the start of next year, right? Start of next year means 1st Jan 20x5 is 20,000. Makes sense? And this will be paid after 1 year, because at the start of the next year, on 1st Jan 20x5, you'll already make this payment of 20,000, right? This remaining 35,662 will be paid after 1 year. All right. Now, always remember, when you have the questions in advance, like for example, you're making payments in advance, you don't need to do one step 1 year ahead. You don't need to do an extra year. You don't need to work out for an extra year. But if you have the payments in arrears that we looked earlier at, right? You have to work for 1 year extra. All right. Moving on. Question number 80. Now, question number 80 says that on 1st April 2007, Pigeon entered into a 5-year lease agreement for a machine with an estimated life of 7 years. All right. Which of the following conditions would require the machine to be depreciated over 7 years? Pigeon has the option to extend the lease for 2 years at a market rate rental. Do you think Pigeon will do that? Because if the requirement is for 5 years only, why would he extend the lease at market rate rental for another 2 years? You get it? Pigeon has the option to purchase the asset at market value. No, if that's an option, he can go out and buy it, right? Ownership of the asset passes to Pigeon at the end of the lease period. Pigeon's policy for purchased assets is to depreciate over 7 years. Now, this does not make any sense. So the best answer is option C, which Pigeon will obviously exercise. That means not obviously, but there's a higher probability of Pigeon exercising it, right? Exercising this option. Okay. Now, 81. Okay. I need to do some calculations, I guess. All right, 81. On 1st January 2024, Badger entered into a lease agreement to lease an item of machinery for 4 years with rentals of 210,000 payable annually in arrears. All right. The asset has a useful life of 5 years, and at the end of the lease term, legal ownership will pass to Badger. Fine. The present value of the lease payments at the inception of the lease was 635,000, and the interest rate implicit in the lease is 12.2%. For the year ended 31st December 2024, Badger accounted for this lease by recording the payment of 210,000 as an operating expense. This treatment was discovered during 20x5 after the financial statement 20x4 had been finalized. In the statement of changes in equity for the year ended 31st December 20x5, what adjustment will be necessary to retained earnings brought forward? Now, this is a very simple question for those who can link to what exactly happened, right? There are certain expenses. First of all, this should be recorded as ROU debit of what, 635. The present value minimum is payment 635 and interest rate 635. Were there any payments in advance? No, annually in arrears. All right, so 635,000, right? And a lease liability of 635,000. Done. So far so good. Now, those who understand what comes out of an ROU, what leads, ROU leads to what? Depreciation. Lease liability leads to what? Finance cost and a payment of principal, right? This is what lease liability leads to. So for those who understand this, they can easily solve the question. 210,000 is a rental payment. All right. So out of this 210,000, there has to be some interest cost as well, right? For example, our first year outstanding balance is 635, right? A rate of 12.2%, right? Total payments that were made were 210,000. That means the principal repayment was 132,530, right? Now this should be taken to finance cost. Again, depreciation is item machinery for 4 years with rentals of 210,000. The asset has a useful life of 5 years. Now, do I depreciate it on 5 years, over 5 years, or 4 years? Obviously 5 years, because it says the asset has a useful life of 5 years, and at the end of the lease term, legal ownership will pass to Badger, that is the lessee, right? So 127. Right? Simple as that. This 5530 credit is credit. Why? Because retained earning increases on credit. Retained earning increases on credit. All right. 210 was parked in the profit and loss statement. That, and the amount that should have been taken to profit and loss statement as an expense was 204,470. That means an excess of 5,530 has been recorded in the P&L for the last year. In the current year, you will make the changes to retain earnings by crediting it. That means by increasing it by 5,530 dollars. So A is your answer. I wanted you guys to do it, but again, like I said, it's a very simple question. That's why I was able to do it in just a few seconds. 82. OWL leases an asset with an estimated useful life of 6 years for an initial period of 5 years. All right. And an optional secondary period of 2 years during which a nominal rent will be payable. Okay. The present value of the initial period lease payments is $87,000. What will be the carrying amount of the asset in our statement of financial position at the end of the second year of the lease, right? Again, I won't be discussing this question. I want you guys to do it. All right, please. This is an easy question. Obviously, it requires some concept, right? First, you need to identify that the present value minimum lease payment is 87,000, right? So ROU turns out to be 87,000. Now, it says, IFRS 16 says that you have to depreciate the asset on lower of two things, useful life or lease term, right? Now, in this case, the useful life is 6 years, lease term is 5 or 7. I believe it's 7 because it says an optional secondary period of 2 years during which a nominal rent will be payable, sorry, right? So 6 years is your depreciation, right? Basically useful life will become your it will basically result in a depreciation of how much? Let's check. So 87,000 divided by 6, 14,500, right? And they're asking that our statement of financial at the end of the second year of the lease. Now, I don't know why I tend to do these questions. I shouldn't be doing it, but I end up doing it for you guys. All right. So the answer is 58,000. All right. Now, I'm promising myself that I won't do the next question, no matter how difficult it is. All right. I want you guys to try it. All right, question number 83 says that on 1st Jan 2026, Slideshow sold a property for its, it's a sale and leaseback question. Sold a property for its fair value of $2 million, transferring title to the property on that date. All right. Now, Slideshow then leased it back under a 5-year lease, okay, paying £150,000, $150,000 per annum on 31st December each year. All right, so that's in arrears, right? The present value of rental payments was $599,000 and the interest rate implicit in the lease was 8%. The carrying amount of the property on 1st Jan 20x6, the date on which the property was sold, was $1.6 million and it had a remaining useful life of 20 years. Okay. What entries would be made in Slideshow statement of profit or loss for the year ended 31st December 20x6? Guys, what I'll do is I'll pause the video. All right, you guys pause the video. Okay. Obviously, I haven't solved the question. I'll just solve it on my own. I'll mark the answer and you guys can confirm it. That's the most I can do for this question because for the past 2 questions, I've been telling you guys to do it. But again, I ended up doing the questions for you. Okay. This is not a difficult question. Remember this. It's not a difficult question. All right. Pause the video and confirm the answer. All right, guys, I've marked the answer. It's A. I'm a generous guy. All right. What I'll do is I will make the double entries for you. That's it. Okay. It's basically I like solving questions, and this is sale and leaseback question. I think people will have issue in this. All right. So sold, that means bank debit. The first line says sold at fair value. That means bank debit 2000. Right. I'm doing it in thousands. Okay. Now, present value of minimum lease payments was 599. All right. 1.6 million was the carrying value at the date this asset was sold. So that means we will de-recognize PP at 1600. That's 1.6 million. What else? Is there anything else that we can do? Yes, 599, right? Lease present value of lease rental payments. So lease liability turns out to be 599. What is the amount of PP that I will recognize? Do you guys know how to calculate this? Now this is the carrying value that I'm retaining. All right, the carrying value that I am retaining. So 599 is the lease liability, but the ROU, that is right of use of asset, right? So that's technically it should be 599, right? But it's out of this 599,000 is basically for a value of 2 million, right? So I'll write it 599. An asset which is valued at 2 million, right? I'm paying 599 for it. Get it? For the remaining for a total of remaining 5 years, right? Now, out of this carrying, obviously there's some carrying value that I'll be retaining, right? This carrying value that I'm retaining will be calculated based on the fair value at the date of sale. So 599 is what I'll be paying for an asset valued at 2 million, right? And out of basically 1600, what I'm retaining is 479. So right of use of asset is 479. Get it? Now let's see 2479, and this is 2199. All right, so we have a gain on disposal. Gain on disposal of 280, right? We have a gain on disposal of 280. So whatever carrying value you're retaining, basically the present value of minimum lease payments or present value of rental payments represents the value that you will be deriving for the next 5 years from that asset, right? So there is, again, like I said, some of the carrying value you're retaining, okay? But again, the retention needs to be calculated based on the fair value, right? So you have the fair value, let's say this is the fair value for 5 years, right? For the next 5 years, and this is the fair value for the next 20 years. Make sense? This is the fair value for the next 20 years because the remaining life of the asset is 20 years. All right. So 5 divided by 20 into, currently the value is 1.6. Okay. This is just explanation. All right. Don't do this. 5 divided by 20 into 1.6. 599 divided by 2000 multiplied by 1.6. All right. Now, moving on. 84. On 1st October 2023, FESCO acquired an item of plant under a 5-year lease agreement. The agreement had an implicit rate of 10% and required annual rentals of $6 million to be paid on 30th September, which is basically in arrears, right? The present value of the annual rental payments was $23 million. All right. What would be the current liability for the leased plant in FESCO statement of financial position? Again, this is A simple question. I don't want to do it. Honestly, I'm bored of simple questions now. All right, it's a straightforward question. All you have to do is make a lease amortization schedule. That's it. All right. Next up, theory. 85 is theory. Which of the following would not be included within the initial cost of a right of use asset? Interesting. This is interesting. Let's see. Installation cost of the asset, estimated cost of dismantling, will not read it. Payments made to the lessor before commencement of the lease, yes, sorry. So B and C both. Total lease rental payments under the lease agreement. All right. So the total lease rental payments are not included. The present value of total lease rental payments is included. All right. Get it? All right. Question number 86, I believe, is the last one. On 1st January 20x4, Stark entered into a sale and leaseback of its property. When it was sold, the asset had a carrying amount of $6 million and a remaining life of 10 years. Stark sold the asset for $7 million and leased it back on a 10-year lease. So that's the entire remaining life of the asset, paying $1 million on 31st December each year. All right. So it's in arrears. The lease carried an implicit rate of 7%. What is the total expense that should be recorded in the statement of profit and loss for the year end 31st December 20x4? He has retained the entire the right of use to the entire remaining life of the asset, right? So what you simply need to do is you have the carrying amount of $6 million, right? The complete carrying amount was retained, right? So the depreciation, let's say, wait. So the depreciation, if I want to calculate the depreciation, it will be 600, right? Depreciation will be 600, but again, since you're selling it for $7 million, you have $1 million in what do you call that, in store, right, as a loan, right? That's an additional loan, right? So 7,000 lease carried an interest rate of 7%. All right, 7%. So the total expenses will be simple, 1090. So that's 1,090,000, right? This is section A question of IFRS 16. We'll see you guys in the next video. Hello and Assalamu alaikum. All right, this is a short video on one of the questions on IAS 21 from section B of your F7 capping kit. I'm doing this because there are students who are having issue in computing gains or losses, foreign exchange gain or losses on monetary assets, because non-monetary is very simple, right? So I'll be doing this with you now. The question says Vance buys and sells goods in Cromets, but has a functional currency of dollars. All right. Vance purchased goods for 10,000 Cromets on 1st September 20x1. At Vance year end of 31st December 20x1, this amount remains unpaid. So basically, there's a payable that is unpaid on 31st December 20x1 of 10,000 Cromets, right? Now, obviously, it's a monetary liability, right? First of all, let's convert it on the date it came into existence, and it was 1st September. I'm calling it 2001. It's 20x1, but I'm calling it 2001. All right. So the rate was 10, right? Exchange rate was 10, and your functional currency is dollars, right? Dollars. All right. So obviously this is a bigger amount. You have $1,000 outstanding as a payable. on 1st September 2021. Vans sold goods on 1st September 2021 for 60,000 cromets. On 1st October 2021, Vans received cromets 30,000, that is 30,000 cromets he received. The remaining 30,000 cromets is unpaid at 31st December 2021. So he also has a receivable for which I'll do my working over here on 1st September. So I'll just copy down everything and I'll change the. Alright, so this becomes a receivable. You have cromets, you have exchanged. This is total 60,000, right? Exchanged on that date was 10. Yeah. All right, let's work it out. Now, the question says we also have the relevant exchanges. I'm not reading this paragraph because this relates to. I'm not reading this paragraph. This relates to IS 12 income taxes. All right, which we'll do later on. What gain or loss should be recorded in the statement of profit or loss for the year ended 30th September 2021 in relation to the payable recorded for the purchase of goods? Now, since none of the amount was paid back, this whole amount was outstanding on 31st December 2001 and according to 2001. Exchange rate turned out to be the only thing that changed was the exchange rate because there was no amount paid. Will we take the average rate or the rate on 31st December 20x1? So that will it will be the rate on 31st December 20x1. Copy down the formula. Now your payable is $1,250. Your payable is $1,250. So there's a fair value loss of $250. All right. So you have a loss of $250. Your answer turns out to be C. Okay. Next up, what gain or loss should be recorded in the statement of profit or loss for the year ended 31st December 2021 in relation to the sale of goods? That is basically your receivable, right? Because revenue is recorded for the year and receivable is as at because it's a balance sheet amount. Now, first of all, on 1st October 20x1, you received, so it's not receivable, it's received. You received what? Sorry, 30,000. And since you have, I'll just, all right, get this. Now, you have 30, you've received 30,000, right? And only a 30 at the rate, you need to calculate the rate. In fact, the rate is given at 10.5, 10.5. All right. So basically, you received 2,857 against, because it was 30,000, that means half of the balance, right? So half the balance at the date at which receivable came into existence was 3,000, half of the balance, right? I divide by 2. And against which you received what? 2,857. That means you incurred a loss of 143, right? That is one thing. 143 is one thing, all right? Next up, you have to obviously revalue this amount at what rate? So the rate is at 31st December, it's 8, right? So it's 3,750, right? Now the remaining half, the remaining 30,000 has been revalued to, because of the change in exchange rate, it's been revalued to 3,750. Originally, this half was, when it came into existence, when the receivable came into existence, it was 3,000, and now it has been revalued to 3,750. So basically, you're entitled to $3,750, right? Just because of the change in exchange rate. So this is a gain of 750. A gain of 750. So during the year, you have a net gain which will come out to be positive sorry, negative, which will come out to be a negative figure of 607, right? Not a loss, because I've done the reverse working. I've shown the gain as negative and shown the loss as positive, all right? So you have a net gain of 607 and your answer turns out to be B. Okay, next up. Last part related to this IS 21. Which of the statements below is or are true? Statement number 1 says the inventory purchase on 1st October 20x1 should be retranslated at the closing rate if the goods remain inventory at 31st 20x1. Question is whether it's a monetary asset or a non-monetary asset. It's a non-monetary asset, all right? It's a non-monetary asset. So this is false. The foreign exchange gains will be added to the revenue for the year. Why? It will be shown as a separate line item or as part of other income or loss in fact, it's a foreign exchange gain, so it's other income, right? It could either be shown as a line item or could be shown as part of other income in your P&L. It will not be a part of your revenue. Okay. So this is it. This was a question that I wanted to do. I'll see you in the next class with IFRS 15. Take care. Bye bye.